Welcome back to the Deal Room, the podcast dedicated to uncovering the strategies and the insights that drive success in real estate. I'm your host, Heyshan Pires, and today we have a truly inspiring guest who has not only navigated but thrived in one of the most competitive real estate markets in the country, Los Angeles. Joining us is Maxx Feldman, co-founder of Goldfinger Group Inc. Max, welcome to the Deal Room.
Thanks, some very nice words.
Max, it's fascinating to hear about your journey. You started as a chemical engineer, played baseball, worked in oil and gas, and then made a significant pivot into real estate. Let's start talking about that, Max. Take us back to that initial spark. What drew you to real estate? And how did that 60-day trial with your new boss turn into an 8-year success story with over 30 buildings in LA?
Yeah, it's not your typical story. I went to school in New York. I was living in Jersey and then Louisiana and Texas doing oil and gas. I was a chemical engineer doing natural gas construction, working in upstream consulting. And I was actually at this period in my career where I was looking to go get an MBA. I was interested in getting to the business side of oil and gas. And kind of like my second family here in LA, I was raised in Calabasas. They said, you got to get into real estate. I don't know what you're doing. And I said, let me see what opportunities are there. And one of them actually introduced me to my now partner. And when we met, he said, let's work on a 60-day trial. I'm trying to grow my business. You're trying to get into real estate. And I knew absolutely nothing. I didn't know what a GRM was, a cap rate. I had no idea how to find market rents. And here we are 8 years later, been navigating this landscape. We had a very great market from when I got into the business in 2018 until about the end of 2022. And now navigating this new phase of the market from 2023 with high interest rates and everything that I'm sure we'll talk about. It's been a great journey where I've learned a tremendous amount in both phases of these cycles that I've been in.
That's an incredible story of growth. I mean, especially in a market like Los Angeles, which many investors might not even consider. So, what's your secret sauce? What makes a Goldfinger Group Inc. successful where others might hesitate to even take?
Yeah, Los Angeles is a city where we have very tough regulations. The regulatory obstacles are real. Everybody knows about them. Our mentality has always been they're not ever going to get more in favor of the landlord. The question is, how much more tenant friendly are they going to get over time? Which is kind of proven to be. And I think you have to be able to adapt as the environment is constantly shifting. Whereas you invest in Texas and Florida and Arizona, you're dealing with the financials. Do the financials make sense? Are we in an up market, down market? How's the rental market looking? Here, you have to deal with laws that are changing all the time, right? Where they implement a tenant has to be at 1 month fair market rent to do an eviction for unpaid rent. They're doing caps on rent increases where instead of charging 3%, now it's 90% of CPI. And so you really have to be nimble and follow along what's going on the regulatory side and adapt as that comes out. The hard part is, I always say, like, if we know the rules of the game, we can play them. And the rule is, right, that these are constantly going to be more tenant-friendly laws that are going into effect, but the rules are kind of changing. And so it just requires very strategic operations. And I think I always say, like, there's a lot of operators like us. Every time I talk to an investor, a potential investor of ours, I always say, like, there's other people doing it, whether it's in LA or in other cities. And so it's our secret sauce is our ability to identify a good deal from a bad one. Meaning, like, when we're going into the project, does this really make sense? Do we have an executable business plan? Do we like our cost basis? Like right now, we just went under contract. We're buying a 12 unit in Koreatown for $137 a foot. It's unheard of at that cost basis. And so that's one side of the equation. And then just our time operating in LA is how we are able to strategically operate these properties, given the headwinds and the obstacles that we're up against on a daily basis.
Very good. You talked about regulatory rules. What about interest rates? Or what about plateaued rents, operating costs, rising operating costs? And how do you navigate those?
It's tough, right? Because on one hand, as I mentioned, you have the regulatory obstacles, and on the other hand, you have the financial obstacles, which I think it's not unique to Los Angeles. Operators across the US and maybe internationally are facing the same things. And at the end of 2022, we were riding this up market. Debt was basically free. Rates were super low. The rental market was on fire. Especially the initial hit from COVID dampened rents, but then we saw tremendous growth after that. And then from 23 through today, we've seen the market drop because we've seen rents plateau or soften and operating expenses go up along with interest rates. And so what we're faced is that deals really have to make financial sense, meaning underwriting under real expenses, underwriting with real interest rates. The idea of interest rates being lower is not a business plan. I heard a lot of brokers saying a couple years ago, well, rates will come down. And it's like, they might or they might not.
Yeah.
It might come down in 6 months. It may come down in 2 years. We don't know. All we know is the current market conditions. And so what we're underwriting to, or how we're looking at deals in our own operations, is adding margin to what we already know. If we're getting quotes at 6%, we'll underwrite deals at 6.25% on the interest rate. We'll
Mhm.
use buffers and expenses to make sure that our cash flow is real, because when you actually get into the operations in today's world where insurance premiums are up, utility costs are up. I mean, here in LA, they kind of monopolize the trash industry, and you have to use the trash operator that services wherever you're located. And they charge whatever they want to charge. And so these are real things that we're facing as an operator and an owner here in Los Angeles, and making sure that the financials make sense, because it is significantly tougher time to own and operate real estate.
Correct. Looking forward, what challenges do you see? What shifts do you anticipate in real estate market? How is Goldfinger Group positioning themselves to stay ahead of the curve? What's your 2 to 5 year outlook look like?
I think if we look back a few years, because real estate cycles happen over periods of time, it's not like the stock market, which does the same thing, but we don't see prices and everything happening every second of the day. And so,
Mhm.
especially with real estate, it works in 3, 5, 7 year cycles, because that's how debt is taken out and people get these loan terms. And so a lot of people were buying 3 and 4 cap properties, depending on the city, maybe 5 caps. We saw a lot of secondary and tertiary markets, cap rate compression, right? Areas that historically traded at 8 cap rates started trading at 4% cap rates. At the same time that people were taking out super low debt, high leverage debt, bridge loans that are coming due. And so a lot of that debt, the motto was survive until 25. I think what happened is a lot of these distressed loans got extended down the road another year to 2 years, where a lot of banks were like, well, maybe the interest rate environment will be better. They'll be able to refinance. And so you have a lot of this, I hate to use the word distressed, but maybe troubled debt that is still lingering out there. We've seen office buildings go back to banks, certain
Mhm.
multifamily properties go back to banks, or just being sold at huge discounts. And
Mhm.
what's fortunate for us is the way that we timed up a lot of our stabilization and refinances is that we still have a couple more years on a lot of these loans to see how it plays out, or 3.5 to 5.5% loans. And so we're keeping an eye on that, on a lot of that debt that's coming due and what that may mean for opportunities. And so the debt is one side of the equation. I mean, it's the big white elephant in the room, high interest rates. And we were hoping rates were trending down right before the conflict in Iran. Rates were trending around 5.6, 5.7, and trending down.
Yes,
And then on the other side of the equation is the operations of the building. So how can you maintain steady cash flow? And
correct.
that's a huge focus of our strategy that we've implemented and we're continuing to implement moving forward, is how can we maintain tenancy and occupancy in our buildings at the rents that we're at, so that you have steady collection, steady revenue. And then how can we, while maintaining the integrity of the property, how can we keep operating expenses from growing as much as they have been? Obviously, some of these things are out of our control with insurance, especially after the fires here in LA. The
Yes.
insurance market shifted a lot, where we got denied policies because we were in a brush zone, even though we're nowhere close to where a fire may occur. So these are things that we're navigating. And so the path forward is constantly being on the operation side of these properties so that we can maintain steady cash flow, while also
Yeah.
looking for opportunities to buy, like this new property in Koreatown that we're.
Correct. Only thing you can control is operating costs. If you can keep the costs low, you get an advantage. And when it comes to real estate, it can go three ways. It can go up, it can go down, or it can stay stable. Can really control that, controlling what you can. Do you also manage properties or do you use a third party management company to manage your properties? Could you elaborate a little bit about that structure that you have and your relationship looks like with these property management companies?
So our business is heavily predicated on finding the right deals to buy,
Hmm.
getting the right investor capital into these deals alongside with our own money that we put into these deals, and then doing the asset management, the investment management side. And so property management is this other component that kind of falls under asset management. The hard part is that property management takes so much time and there's so much headache involved. And here in LA, there's so many companies that specialize in it, and so what we've done is we've been able to outsource our property management to third party because it reduces the load on us. It's just my partner, myself, and the girl who runs the back end business, all the admin and everything on the back end. There's also a lot of liability here in LA with property management. And so it makes it where the gross revenue, if you're taking 4, 5, 6% of the gross revenue for management fees, has to be high enough to justify having it in-house. The property that we're buying, it's a wealthy family, multi-generational. And so they do all the management in-house because they own enough units, thousands of units throughout LA. For
Hmm.
us, it doesn't quite make sense. And so what we do is we find people that are successfully managing properties across our working with them, making sure that they're aligned with how we're trying to operate the investment, getting aligned on once we buy the property, taking it to where we need to go. And then we just manage them. We have weekly calls, we have texts, phone calls. We're very active. I always tell the property managers, we're not, we're pretty easy to work with, but we're a little high maintenance because we're so heavily involved. But because we're so heavily involved, maybe it requires a little bit more time, but it also takes things off their plate because we'll notify them, hey, there's rent increases coming due, or hey, here's a great vendor to use for this issue. And so we've just developed a lot of great relationships with people who are doing management here. Something that we've thought about bringing in house. I don't think we're there yet, though.
So instead of managing the renters, you manage the property managers. How often are you meeting with the property managers? Once a week, twice a week, or once a month? How often do you meet with them?
We have weekly calls. We also have text threads, email threads, calls that are not scheduled. We also, I think, the beauty of investing in LA is that I live on the west side. I always tell people worst case scenario in heavy traffic, which is pretty typical for LA. I'm less than an hour from every single one of our buildings. I go to the properties, I see them, I point things out. And so this
Mhm.
is what I mean. Like we're heavily involved. We're constantly going to properties. We have our own internal books and records that we keep for ourselves to, it's not to hold the property managers accountable, but it's that we also know what's going on. And so if things are slipping through the cracks, we can let them know, hey, there's this going on or you missed this. And so it's very open dialogue, open relationship with all of our property managers.
Got it. Could you explain the type of properties that you have for our listeners? Is it multi-family units or is it commercial units? If it is multi-family, what's the number of tenants you have in a property on an average?
When you look at Los Angeles, and we would have to go back and look at old zoning codes and development, but most of the properties are you have a lot of areas that are 2 to 4 units, and
Okay.
then everything else is mostly 5 to 30. We're not like Texas, and obviously a lot of these developments happen later in other states, but most of LA was built in the 20s, the 30s, the 50s, and the 60s. You have some 70s and 80s and some newer product. And so most of the properties are between 5 and 30 units. And that's where we specialize. We're dealing with a lot of mom and pop owners. Los Angeles historically was owned and operated by mom and pop owners, where instead of investing in the stock market, they were buying properties every few years and building up a retirement portfolio. That environment's now changed, which I'm happy to get into. And so that's what we buy. When you're dealing with sophisticated, once you go above the 5 to 10 million range, you're starting to deal with more institutional style investors, and it makes it a lot tougher to navigate that space. And that's been our niche is buying the value add real estate. We want to buy from owners who have owned these properties 20, 30 years, who haven't really touched it. And now we can come in, fix up the property, fix up the units, build ADUs. So what
Mhm.
we're called what's a value add investor, where we can buy a building for $2 million, put $1 million into it, And now based off the income, hopefully it's worth 3.5 to 4 million. So we're creating value through strategic renovations, building out of ADUs in our operations.
Got it. So pretty much it could be 4 units, could be 30 units in a building, and you try to go after owners who have owned these properties pretty much now instead of
And
going through
untouched. Yeah,
got
we're
it,
looking for untouched properties.
untouched
And so
properties.
people that have bought in the past few years, there's nothing wrong with that. The question is, did they already try to do a lot of the work, a lot of the value add, lifting
Mhm.
these properties up that we can't go in and do after them? So the profile doesn't fit us, but the long-term untouched properties, 5 to 30 units where we can go do renovations and build ADUs, that's what we're looking for.
Got it. You mentioned most of the properties in LA were built in the 20s, 30s, 40s. Do you have any concern purchasing properties that old?
What we see is that, especially from long term owners, a lot of the systems haven't been updated. So you're finding buildings with a lot of galvanized piping, old electrical foundations that may be cracking. And
Mm,
so, obviously, depending on the location and how the foundation was built. And so that's a lot of it. Also, because LA, we don't get a lot of rain, we have 330 days of sunshine a year. A lot of the roofs, people don't touch the roofs. We bought a property in Venice, it was a 14 unit and the roof hadn't been replaced in 50 years. And then when we're doing our inspections, we found all these leaks. We found mold buildup in the property. And so roofs are big in LA because most people don't think it's an issue until you go up there and realize, wow, this thing is old, it's beat up. And so I would say, when we're buying these buildings, we factor in that we're going to have to put on a new roof, which will cost between 10 and 25,000, depending on the square footage. We're going to have to go update the electrical panels. And that's a big issue right now, specifically in LA. Insurance carriers won't allow Federal Pacific or Zinsco panels because they have fire potential. And so purchases, what they were doing a few years ago is that you could buy the building and replace the panels later. Now a lot of carriers say we won't even write the policy until you actually replace the panels. And then as we're doing other renovations like adding ADUs and more units, is replacing all the galvanized piping and the main line. Even the sewer line, we see a lot of them are clay or cast iron, and
mm.
they're falling apart. And so now you have to go do $20,000, $30,000 sewer line replacements. And this is, I don't know if you know Graham Steffens, but he talked about he was building an ADU at his house in mid city. I don't know if he still owns property here. He moved to Vegas and is starting to do other things in Vegas. But when you build an ADU, the city now requires that in order to get your certificate of occupancy, the final sign off from the city, and now you can go rent it, you have to do a sewer line inspection. And now what they're finding is all these old sewer lines, even though there's no problem, if it's cracked, if there's a piece falling apart, now you have to go spend an additional $20,000, $30,000 with the plumber to replace it. And so, yeah, these are
Absolutely.
big things that we're seeing with older products.
Very good. So you buy a property and then you add value to the property by making updates, right? And then let's say now you brought in a bunch of investors to purchase the property and then you added the value. How do you pay back the investors? Do you have an exit strategy? Do you hold on to these properties in the long run? How does the investors get their money back or some of the funds back?
Early on, especially up until 2022, a lot of our strategy was predicated on adding the value, exiting the project, and then doing a 1031 exchange and buying the next property. So buy property A for $1 million, make it worth 2 million, sell it, take all of that money and go buy a building for 2.5 million. And it was working for us. And two things kind of happened. We realized that it takes a lot of work to reposition these properties. So instead of selling them, let's look to refinance and hold them for cash flow, because that's ultimately what people want investing in real estate is the passive, what people deem passive income. If you're an LP, it's passive. When you're the general partner, it's a lot of work, but they want the cash flow, the quarterly, monthly, annual distributions. And so we started to refinance a lot of properties and hold these for cash flow. At the same time, interest rates started to go up, the market shifted, and the sales market completely dried up. And so exiting and selling a property wasn't a business plan strategy anymore because you couldn't find a buyer who was going to pay a price high enough to justify the return for a sale. maybe you'd break even, maybe you'd make 5% or 10%, who knows, but it wasn't there anymore. And so our strategy started to shift, especially after we had sold so many properties, done 1031 exchanges, churned that capital and leveled up that way, is
Uh-huh.
how can we now stabilize these assets? Exit is not an option. How can we get to a place of solid cash flow after stabilization, after building ADUs? How can we create enough net cash flow every quarter for our investors where they say, yes, I want to get into these deals with you? And that's been our strategy now, is heavily focused on day one cash flow. Everybody talks about upside potential. Our number one criteria is downside protection. Early on, it was, if this deal doesn't go to plan, how can we sell and return all of the investor capital to them? In a worst case, because that made me sleep at night. If you invested 100,000 with us, if worst case, I can get you 100 grand back, I can say, hey, I'm sorry, it didn't work out, but at least I made you whole. And
Yeah.
now today, our downside protection is looking for day one cash flow. If we can be above treasury, so we always say around 5% day one cash flow, with the ability to get that to 8 to 10% cash flow through a lot of these renovations and building ADUs that we do, that's a good investment for us. At the same time, over that period, in 15 to 18 months, can we refinance and return, 50%, 75% of the original capital to investors?
Got it. One final question on this line of thought. You said refinance. When you go to the bank to refinance, what does the bank look for? Because let's say it's a 15 unit property, apartment complex. It's not like there's another 15 unit down the street. You can say, oh, that's $1 million. So mine would be 1 million or close to 1 million. How do the banks value that property for you at that point?
They're doing a couple things. And we actually just went through this process where we needed three things to line up, and unfortunately they didn't. And so the lenders giving us a 1 year extension, which is really great. But what they're looking for is, banks are underwriting deals in two capacities. They're looking at loan to value, LTV. So they're looking at the appraised value of your property. And then they're doing what's called a DCR, debt coverage ratio, or DSCR, debt service coverage ratio, where they're looking at your NOI, your net operating income, and comparing that to your loan payments. And they want to make sure that your net operating income is around 20 to 25% higher than your debt service. They want that buffer in case operating expenses go up, rents come down, that you're not going to miss payments or, default on your loan. And so they're looking at your actual operating income and expenses and making sure that the DCR checks out. And at the same time, you have to do an appraisal. So right now, as we're kicking off this with this purchase, we went to the bank and we said, "Hey, here's all the financials, here's everything," and then you schedule an appraisal. 2 weeks later, you do the appraisal, and then 2 weeks after that, the appraisal comes back. And what the appraiser is looking at is other buildings that have sold in the area, comparable product. If it's an old building, you can't compare it to new construction, and vice versa. And so they're looking at normally price per unit. So if it's a 10 unit and everything's trading at 2 million or 200K a unit, does that check out with what you're doing? They're looking at price per square foot. So is it $200-300 a square foot in that market? And then they're also looking at income. They also want to make sure, the appraisers want to make sure that your cash flow also lines up with other buildings that are trading in the area. And so banks are making sure that the actuals and the appraiser line up to what the actual debt's going to be.
That's great insight. Somebody who's getting into multifamily, these are some of the things that you need to start looking into and read about, get yourself well versed because you buy a property, you think it's a great deal, you do the renovations, and then your last step is to go get your money back. And if that appraisal value does meet your requirements, you kind of messed up. That's great insight for our listeners. They got to make sure the rent is right, the rent value, the income that you're getting is 25% more than the debt or the loan value that you need to pay.
Otherwise, what the bank will do is they'll cut your loan size. So if you
But
thought that you were going to get $1.5 million loan, they may come back to you and say, hey, unfortunately, we can only do 1.2 million now. And as we talked about what's in your control and what's out of your control, you can always push back with the appraiser if you have your own comps and own underwriting and things that you can say, hey, look, I think your value is wrong. But you can't change the interest rate environment. And I think a lot of people, this is a big caveat, is that rates were low, and then as they started to go up, your DCR comes down because your loan payment goes up. As interest rates go up, to get the same loan value, you need more income. And so that's something that's been out of everybody's control over the past few years, is how high interest rates are. And that brings us back to what I brought up earlier, where when you do your underwriting, when you're looking at deals, you have to not only underwrite to today's market conditions, but add margin in there and have buffer just in case, because we don't know. And so
Hmm.
people that were underwriting hoping rates were going to be around 5% today are in some trouble because they're at 6.25. And so
Correct.
that's why it's so important to have margin and buffer when you're underwriting deals, and also in rents, because if your rents drop 5% or 10%, if the market drops that much, what does that do to your income? And what does that do to your cash flow and your value? And so I think it is so important, like you said, to know these things.
All right. A topic that I'm passionate about is how do you see that making changes in the real estate market? Do you see in the underwriting world or maybe in the property management side of things any role that AI might be playing in the future that investor who's getting into it should keep an eye on?
Yeah, I think AI will get much more involved as it comes to real estate, especially on the operation side. What's interesting about real estate, it's still this physical touch and feel, tangible asset class where you have to see the property, know where it is. I don't think AI can assess
Right.
that and know the condition of the property. Unfortunately, it can't, not yet, not until Elon builds the robots can AI go to the property. But
Yeah,
it is a tool that I think can be very helpful. And I think it's only going to get more refined. I read someone, a pretty high net worth GP, put a post out on LinkedIn and said, I put in this investment opportunity into Claude, and it said, if you do these things, you'll make 17%. And then I did it again and it told me 13%. And it did it 5 times and it came up with 5 different answers, which I think is real, right? Like the truth is that when we underwrite deals, we look at worst case scenario, best case scenario, and then kind of our base case, which is somewhere in between. And the truth is reality will fall somewhere in in that spectrum. And
absolutely.
and so I think AI will be a tool to help underwrite deals, or be able to gather information to assess what the market rent is, or where the comps are at. So I think it will be a tool that will help gather information. I think it's also on the management side, helping with tenant communications and vendors and running Appfolio and doing P&L review. I think that's also a great tool where AI has a place within real estate.
Got it. Final thoughts. Any suggestion, advice that you would like to give the listeners who are new to the real estate world? They're trying to get into maybe working on their first multifamily deal or single family deal, or maybe even commercial, industrial. They're trying to get into this field. What final advice would you give?
A lot of pieces of advice, as I've learned, made mistakes and learned from them. I think a few things, a few pieces of advice, or just my thoughts from my own experience, is that you can't force the underwriting to work. Everybody loves to live in the spreadsheet. Unfortunately, the classroom setting is only as good as the classroom. There's the real world. And if you're forcing the numbers to work, if you're saying, hey, if I can hit these rents, if I can lower the expenses, but in reality, it may not happen. And so we underwrite deals using our calculators on our phone and do everything back in the napkin. And so long as it passes that test, then we bring out the spreadsheets and start to really work in the spreadsheets and spend time. And paired with that is that we're putting margin in when we're underwriting. I mentioned this earlier. Our construction costs, if we think it's going to be 50,000 a unit to renovate, we'll put it at 60. If we
Mhm.
think that upgrading the plumbing is going to cost 100 grand, we'll put 125,000. If we think we'll get 2 grand for rents, we'll actually put it at 1,800 and make sure that the numbers still make sense. So long as you have buffer, you don't get caught in the middle of operating the investment. And if things do work out as you planned, it's just additional profit on the back end. And I think the third piece, it's the old adage about location. I think location is so important in today's world, especially when you're dealing with a down market. Better locations are just much more resilient, and owning in better locations usually leads to lesser headaches. It doesn't mean you're going to avoid obstacles and headaches, but there is a likelihood that things are going to be a little bit easier during that investment cycle.
Correct. Very good insight there. It's been a great conversation. I think this would benefit a lot of investors who are trying to get into this market. Before we wrap up, where can our listeners find you and learn more about the Goldfinger Group Inc?
Definitely. We started a few years ago during COVID doing Instagram lives that has now transitioned into putting out a lot of content on our Instagram, on TikTok, at the Goldfinger Group. I personally have at Real Estate with Max, where I have plans to launch a education platform to help people understand real estate investing because it's not taught to us anywhere. And I learned trial by fire, just getting thrown in the deep end and learning how to swim. So at the Goldfinger Group, at Real Estate with Max, we're posting a lot of content of our projects, tidbits about real estate, and just trying to help people get educated and show what it actually is like to own and operate real estate, and specifically here in Los Angeles.
Thank you so much, Max, for sharing your expertise and the inspiring journey with us. It's truly valuable. Thank you so much. And thank you to our listeners to tuning in to Deal Room. We'll be back next time with more insights to help you master the world of real estate. Have a good day.